it's a great little bullet point thing to say, why is estate planning more complicated than going to the person that has a general practice that took care of my residential, buy or sell, and it can get complicated. And I always say as a lawyer, it's not what you know that hurts you, it's what you don't know that comes at you that hurts you. So this is just a great little checklist of where things can get complicated. I don't know that we need to kind of go through this, but it kind of speaks for itself. On the other side, I've got a good friend of mine who is a Northwestern Mutual guy. He was on the floor for a while. His name is Tim Hender, and I asked him to give me just a couple things about long-term care insurance. So there's some bullet points here about long-term care insurance. I would echo your comments earlier, John. Annuities can be good, may not be good. It depends. Long-term care could be good, might not be good. It depends. Insurance may be good, may not be good. It depends. Just like many other things, it's got to be, why do you have it? What's it accomplishing? And do you understand it? And then, again, can you afford it? That is sort of the general outline I wanted to roll out. I guess I'd like to open it up for questions. I can kind of go further on some other areas, but I think we could probably cover some questions. So I guess let's start back of the room and go forward. Anybody in the... Yes, please.
Two questions.
Please.
You mentioned putting everything in the trust and funding the trust. Generally, they say don't put your IRAs in the trust. So how do you feel about that? And secondly, can you give us a little more specifics as to the money that you put in the disclaimer trust?
Sure. So we'll go in reverse order. The disclaimer trust, so at the time of my death, I have 3, my wife has 3. I've passed away. If you noticed in that chart, it says I give everything in what I call a family trust, but point 1 says my wife can withdraw it all upon request. There's no restrictions, no limitations. So she can just simply yank it out and combine it. So my wife has to look from over here saying, if I took 6, what does that mean for me for my tax purposes? And she's got 9 months. A qualified disclaimer under 2518 of the Internal Revenue Code must be in writing, must be within 9 months, has to be irrevocable, and my wife, the person making the disclaimer, cannot control where it goes. So my document says if my wife disclaims it, stick it over in the disclaimer trust. So it's really up to her to think it through from a family perspective. Works great at first marriages, not so good on second marriages, and would highly not recommend it on third or fourth marriages if you have kids on prior marriages. So it puts in seriousness, it puts a lot of control on my spouse to decide the ultimate disposition of the property. Not a big deal when it's it's the old beaver cleaver, husband, wife, kids, one marriage. Much more complicated. That other chart on second marriages is a much better chart to protect the kids from a first marriage. So did that answer that question? And then funding. You're correct. You've got to look at what you have and where you want it. There's magic with retirement accounts. The magic is I never paid income taxes on the money that's in there. And it's gotten to grow without paying any income tax. But we were talking about the not so good side about retirement accounts. When you take it out, you have the joy of federal income tax and possibly, depending on that state chart, state income tax, depending on where you are. The only big exception is a charity. So in the funding on the 3rd page, it'll say, for a couple, my first beneficiary, because I always favor saving income taxes, current income taxes, over future death taxes or estate taxes. So my comment always is, first spouse, then the revocable trust. But you've got to be careful about the revocable trust. There is a provision you must have in your revocable trust so that if it goes to the kids, that says if a required minimum distribution is required, then it must be treated as income and paid out to the kid. Otherwise, you will lose the ability for the child, if your spouse doesn't survive you and it's paid to your trust, to stretch it over their lifetime. So you can't just, so the simple approach, most people approach, just it goes to the kids. But then you've got that 18-year-old kid, possibly, or 18-year-old grandkid, that's got, you know, $400,000 in an IRA, grabs the money, goes to Vegas, blows it, and now has a $100,000 income tax liability and doesn't know how to pay it. So not the legacy we were looking for. So you know, but that, read through carefully that 7-page funding memo. It's very specific because those are our general recommendations, but it's fact specific. Great questions. Yes, please.
So one of the points on the Better Call Roads is if your majority assets are held in IRA 401k.
Yes.
Can you talk about that? Why is that potentially?
So, boom, there you are. You've got $6 million. Your wife's got 3. If you left all 6 to your wife, she's now got 9. No death tax, no transfer tax. But she's got how much? 9. I have to go and flip to the state chart, but she passes away of a broken heart the next week. You're going to have a huge state death tax. So how you manage these IRAs and how they're just a much harder asset to manage because of the tension between estate and income tax.
I guess what I'm talking about is passing on the IRA to the kids.
And there's a lot of different ways that you got to kind of look at where's your end point. What are you trying to accomplish endpoint wise? And you've got to look at it. When I put on my lawyer hat, the first question I must ask is, who is my client? And my client's the husband and wife sitting across the table. If they say, I would like to have a certain amount go to grandkids, great. If they, you know, so it really depends what you want and what your assets are and how much you're able to do things with. That's where you can get creative. I was talking to somebody earlier, but I try to throw out a bunch of different ideas, almost a little bit of a buffet, to decide what's the right structure. You certainly could take a portion of your retirement account, your IRA, let's just make life simple. Pretend you had a $4 million IRA plus your other assets. You could break off one IRA with $500,000 or $750,000 and leave that to the grandkids. Why? Because my spouse had enough. If my spouse doesn't have enough, you don't have that choice. So it's a really hard one to be specific about. I was just talking to somebody earlier today that the discussion was, geez, mom might be here for 2 years or 3 years. I said, well, you ought to really manage her IRA so that you're running up the appropriate income tax bracket, because when mom passes and it goes to you, you take it out, it's at your bracket. So there may be a reason to take out more than the required minimum, depending on your tax brackets. I've had instances where the clients are like, I'm done with Illinois. Nobody likes paying the federal income tax, but remember, that's all pre-tax money. But I'm moving to Arizona. Maybe I take out a bigger slug than my required minimum distribution in 2018, paying how much state income tax on that IRA?
0.
Now I'm going off to Arizona. That money's out of the retirement account. So there's a lot of little planning. Is it going to eliminate income tax? No, you got the feds. The feds are going to get their money somewhere, somehow, unless you leave it to charity. Is that, again, I'm trying to answer it in a general way, but it really is very specific. This is the end point I want to get to. How might I get there, and how does it play?
Michael, though, as far as the trust, how you name the trust and how the trust is taken care of as to whether the individual can use their age for RMDs is that part of your question? I don't know. It becomes difficult.
Did I answer your question okay, or do you want to say it a little differently, or we can talk a little bit after if you want to be a little more specific? okay, or so-so?
And if you ask questions, please make them loud so we get it on the video.
Yes, please.
Everybody.
Any recommendations on how to pick an executor?
Yes. I refer to it very simply. It is the island of burden. It is a pain in the butt to be an executor. You have to, executor or trustee. The core of trustee is trust. So you've got to have somebody with a very high level of trust, that they'll do a good job. They've got to be good taskmasters. They've got to be organized. They've got to be thoughtful. They've got to be somewhat diplomatic as opposed to tyrannical, a tyrant. So those are important factors, and you've got to be realistic about it. It's always very interesting when I see the kids say, well, Dad named my brother and not me. I'm like, this is when you say thank you.